economy continues to operate at an above-trend level. It's doing just fine. The labour market remains solid. Let's get more from Candice Bangsund, Vice President and Portfolio Manager at Fiera Capital. Thanks very much indeed for joining us.
Thanks for having me.
Just looking at focusing on U.S. stocks and the U.S. economy, there's no economic reason anyway why stocks should stumble at this stage.
Well, in our view, like you mentioned, the resilience of the U.S. economy is just adding to those upside inflation risks when we're already seeing inflation that's fairly sticky. You mentioned the job market, unemployment's at historic lows. This is keeping upward pressure on wages. We've seen that disinflationary narrative ultimately just stall out here this year in the United States. And most worrisome, I would say, was the data on Friday showing that consumer inflation expectations spiked to a 30-year high of 3.5%. This is obviously going to raise some red flags at the Federal Reserve and ultimately limit the scope to which they can lower rates from here. So we think the Fed will be sidelined here in 2025, and that's something that's not priced in the market and could create some downside, going forward.
I skipped over inflation there. It was a pretty big omission. I should have mentioned that. So we got reasonable growth in the States, strong labour market. But you think perceptions of inflation, if nothing else, are likely to be or could well be a problem?
Yeah, well, like I said earlier, the data is reflective of higher inflation. You mentioned the above trend or above potential growth in the U.S. economy. That's inherently inflationary, and cutting interest rates into an environment of above trend growth risks fanning the flames of inflation. And now, with the looming risk of tariffs, consumers are expecting higher prices. And like I said, this is something the Fed pays very close attention to, is those long-term inflation expectations. And now they have de-anchored to the upside. Like I said, 3.5%. This is, not ideal for a Fed and an easing cycle at that.
And Canada, you are in the camp that says the Bank of Canada's hands are partially tied. They can't just keep cutting willy-nilly because it could drive the Canadian dollar down.
Exactly. The situation where we have the Fed sidelined in 2025 really does complicate matters for the Bank of Canada that actually needs to cut interest rates further. You could argue that, and particularly if these tariff threats become a reality. But like you said, the risk is that, with the Fed on hold and the Bank of Canada cutting rates, that differential, that's already at historic levels, results in a weaker Canadian dollar, which is inflationary also via import prices. So we think that limits what the Bank of Canada can do when it comes to maneuver room. The economy here, like the recent data, has actually been pretty strong. It looks like we're on the road to recovery after, the 200 basis points of rate cuts that we've already seen. Somewhat problematic is that the CPI numbers last week did reaccelerate as well. So all that to say, we don't think the Bank of Canada can lower interest rates much further from here.
So your most high probability scenario is, you title it inflation revival. We've touched on that. But you say that in your scenarios, you've introduced a new one, stagflation, and you see a 25% chance of that. I think you're talking about the U.S. economy or the U.S. and Canada.
I mean, the stagflation scenario is largely a global one because, of course, it's really, you could also call it trade war. And that's really why we introduced that scenario into our matrix. The prospect of a trade war is stagflationary because, of course, it results in higher consumer prices. But regrettably, it also results in slower growth. So a stagnating economy coming up against higher inflation. That's an extremely detrimental scenario for both the stock and the bond market, and helps to justify why we have a defensive approach to asset allocation right now, and particularly in light of equity markets that are already trading at pretty lofty valuations.
For an investor who shares your apprehension or concern about possible inflation bouncing back, what sectors do you think they should go into?
Yeah, so I mean, the overall view is one of higher interest rates for longer, higher inflation. So we think there could be a rotation from last year's winners to last year's laggards. You could see something from a growth to value, trade take hold in this environment. And that would inherently benefit the Canadian market versus the U.S., where valuations, I would argue, are the most stretched.
Yeah, and it is interesting, we've touched on this already on the show, the Mag 7 stocks as a group down this year.
Yeah, we're already seeing that rotation take hold. And remember last year, the story was one of a soft landing. That was that optimistic scenario where you have non-recessionary rate cuts. Interest rates were tumbling lower in response. That was relatively more positive for those longer duration stocks in the Magnificent Seven. It was very much a narrow equity market rally in 2024. Now that narrative has shifted to an environment of higher inflation, higher interest rates for longer, we're seeing that rotation take hold. And now those sectors are the most vulnerable should interest rates move higher at the long end of the curve.
We'd better go. Candice, thank you very much.
My
Candice
pleasure.
Bangsund, I really appreciate it. Candice Bangsund.